Thank you. This session, delighted to say we're doing in partnership with OakNorth Bank, and Ben Barbanel, Head of Debt Finance for OakNorth, is joining me to have a chat all about the lending landscape. I think obviously, as we've been saying, the earlier sector has been affected by the pandemic and has had to show incredible flexibility and resilience in the last few years. But nonetheless, there is a lot of pursuing buy and build strategies and investing and moving beyond purely traditional childcare and hours to offer additional facilities and maximise on previously underutilised space and time. So in this session, I'm going to have a chat with Ben, who's worked with a number of operators, and then we'll throw it open to the floor for questions and comments from you. Just say that this session is being filmed, so I hope that's all right with everyone. Thank you. Okay, welcome Ben. And for those in the room who haven't heard of OakNorth Bank, can you give us a brief overview of the business, how you came to be and what you offer and how much you've lent?
Sure, thank you, and good morning everybody. So for those of you that haven't heard of us, OakNorth is a relatively new bank. We got our banking licence back in 2015 in the UK. We were the third new bank to get a new licence in over 150 years. Since then we've lent over £7 billion into the UK, a good several hundred million into the early years sector. And what we've tried to do is focus on identifying all the frustrations that entrepreneurs have experienced with perhaps some of the larger mainstream banks and enable some smoother routes through to cash for borrowers.
Okay, and is that the main thing that you would say was different about OakNorth's offering versus other banks?
Yeah, so all we do is lend money. We don't do anything that I would call boring like day-to-day banking or anything nasty like that. So all we do is lend money. We lend money for growth, for acquisition, for change of control, for rollout, for all sorts of different reasons. And I suppose the uniqueness of OakNorth is that we operate at immense speed. We're very flexible, we're commercial, we don't have any kind of products that we pull off the shelf and try and squeeze our clients into. Everything we do is custom built or made around a business that we're looking to support. And probably most uniquely, every single one of our borrowers gets to meet the bank's decision makers that ultimately decide or not whether the bank's going to lend money.
Okay, so it'd be good to look at a couple of the operators that you've worked with. We heard earlier from Courtney about ICP education, and I believe you've supported ICP and Tracy's story on their buy and build strategy, so it'd be nice to look at that a bit. I mean, first, for those in the room who don't know, can you talk a bit about what a buy and build strategy is?
Sure, so buy and build strategy, basically buying a business or a platform and looking to expand that with growth through new units, maybe new startup units or other acquisitions to come into a group to effectively expand that brand and that operation. Tracy Story, ICP, was a group that we backed originally in 2017. We did 3 deals with that wonderful team. They sold the business last year for a lot of money, and we're now supporting them in their new venture, which is called Melrose Education, which is focusing on the special educational needs market.
Right, okay, and so what kind of support did you give to ICP during all this?
So we provided debt initially to enable them to open their first settings, to acquire multiple both freehold and leasehold sites from other operators, retirement sales. They acquired a couple of groups to add into their group, and we provided the debt all the way through their business until they sold.
Right, and so Melrose Education, what kind of settings are those? Can you tell us a bit more about?
Yeah, so that's really interesting. That's something that I would call really non-traditional. So these are settings that aren't perhaps in line with where the market's been historically. So they're taking, as an example, they're taking office space and converting it into SEN settings. They're taking non-high street locations, non-village locations, and really focusing on what I would call property arbitrage, opportunity to find space at perhaps cheaper levels of rent or cost, and create settings in those locations.
And are these early years, or do they go further the age range?
Both.
Yeah.
So all the way up to, I believe, 16, but maybe don't quite remember that.
Yeah, okay. And how about some of the other transactions you've done recently? Strawberry Fields?
Yeah, Strawberry Fields is a great, unique setting up in the north of England, where certainly from what I'm aware of, probably a first of its kind, they've integrated a swimming pool and a swimming school within the nursery setting. And I remember hearing about it first and thinking, wow, that's quite interesting. Health and safety, how's that going to work? And they've built this nursery around this swimming pool concept, where children get to swim regularly, and then they go further and allow parents to use the pool whilst kids are being cared for. Really interesting, really unique as far as I'm concerned. They've integrated kind of a cafe on the premises as well that's open to the public. Clearly some logistical health and safety and safeguarding issues there, but so far so good.
Yeah, and Side by Side, another one that you've done?
Side by Side was a school in North London that has been operating for many years from non-purpose-built council premises, and they've been looking for a new site to build a purpose-built operation for a long time. They found one, and then COVID came along, so they really struggled to get funding. We provided them with debt 2020 to enable them to build out a new purpose-built school, which is on track for completion later this year.
Yeah, great. So, as a lender, then, what factors affect your lending when it comes to early years deals? What are you looking for? What do people need to be doing?
I think as a banker, regardless of what sector you're operating in, I think key is management, and effectively, banks are making a lending decision ultimately based on who they're lending money to, just like they do when they lend all of us money for our own personal home. So really understanding management experience, how they've dealt perhaps with turbulence in the past. Markets are always very cyclical, so there's always ups and downs, and understanding how management have navigated those times in the past is always really useful. Understanding plans, understanding growth aspirations, those are the things we focus on. And then rather kind of secondary to that is location, where settings are going to be, if there's specific niches to a business as to how they differ from competition, understanding demographics in those locations, and then the obvious, I call it hygiene factor, but clearly it's incredibly important, things like safeguarding, health and safety, etc.
Yeah, and how have you seen business go over these last couple of years with the pandemic, sort of, the 2020 obviously being kind of big shock to everybody, but 2021 maybe.
I mean, look, from what we've seen, the sector has held up incredibly well. It's been very resilient. We've seen lots of our borrowers really be nimble with their operations and really learn to adapt and really come up with some innovative things to help working parents. But certainly for us, in our experience, the sector's held up really well. Occupancy's been and remains strong. I think if the pandemic's taught us anything, it's that parents will always work and they'll always want some time away from their children. That's I guess that's helped as well.
Yeah. So what are some of the ways that customers of yours have adapted during the pandemic?
I think technology has really evolved. We've seen evolution in all sorts of online portals for operators to keep parents informed. We've seen innovation around what settings provide, like the swimming pool story I mentioned earlier. We've seen home learning techniques being used, a real mix of stuff.
Yeah, okay. And if we look at, well, as we've heard, recruitment is obviously one of the major challenges for the sector. It has been for some time and really intensifying at the moment. And Busy Bees, for example, has launched a huge drive to take on 700 new apprentices. Do you think initiatives such as this are going to help? Is this going to help to overcome the labour challenges?
I mean, I think everybody in this room would acknowledge there's clearly labour challenges in this market and several other markets. I think initiatives like that are phenomenal for the sector and all sectors. We've just provided some money to a business called Apprentify that are doing a similar thing in training people. And ultimately, in a people business, if you don't have people, you don't have a business. Multiple sectors have struggled with human capital. This is one that's been particularly affected, and is probably a worry for everybody in the room right now.
Indeed, I'm sure it is. We can maybe talk about that a bit more widely with everybody in a little while. So we've seen the likes of Busy Bees, Thrive, Kids Planet continuing to acquire smaller and medium-sized nursery groups. What are your predictions in terms of seeing more consolidation in the market?
I think there's always consolidation. I think consolidation exists in all markets. I'm sure there's a view that the big bad PE boys are going to mop up lots of operations. I suppose on a personal level that's not all bad. It's not necessarily all good, but there is some good from that. And I think that consolidation will continue. I think that as the economy recovers fully from COVID, I think we will probably see the emergence of what I would describe as the zombie business, which will exist in most sectors, where ultimately a business is only able to survive to kind of just about cover its costs and not really provide much growth or much upside for entrepreneurs, which is going to be a problem for some. So ultimately that will lead to continued consolidation.
Yeah, and I mean, I think Courtney was saying that she hadn't seen that much in terms of distressed sales at the moment, but obviously there is some. And do you think there'll be an increase going forward in that?
As I said, I think as we come further and further out of the pandemic, I think we'll see a level of businesses that realise kind of they're not able to push on and grow and make the money that perhaps they thought they could. And ultimately, with things like staff shortages, perhaps provide the level of care and service they wanted to their markets. Debt cost is still relatively affordable, but interest rates are on the increase, so that will put operators under pressure further. I haven't yet seen distress, but unfortunately it's inevitable in every economic cycle.
Yeah, okay. And what about debt over-gearing? Do you think this means that private equity will look to sell, to divest assets?
I don't think so. I think, if anything, private equity will continue to invest in this sector. It's a sector that's been led by the private equity businesses. I think what we will probably see is private equity groups that do divest will end up divesting to other private equity groups. So there'll be like recycling of capital around that community. And then private equity groups will continue to try and buy and build smaller chains.
Yeah. I was interested in the UCL report that came out recently, which kind of forecast doom and gloom and collapse of the childcare market, really sort of drawing parallels with the care home sector as well, and because of the high levels of debt that nursery groups have got. What do you think to that?
I mean, look, debt is a facilitator of growth to many businesses. Some businesses, some entrepreneurs are against debt, some entrepreneurs are debt junkies. And I think growing a business predicated, there's a few smiles there, growing a business predicated on debt only is a challenge. And one of the things that we say to management teams regularly is this isn't for the bank to take risk on. Banks are there to fund what we call known or near known cash flows. And in all businesses, in all sectors, there is equity risk, and the equity risk is up to an entrepreneur, an owner to take themselves, and not a bank. And therefore, that mix has to be correctly structured and right for the business, for the sector.
Yeah, and so could you say a bit more about how nursery operators can decide on what the best funding for their needs is, if it's, as you say, debt, equity, both?
Sure. So in my mind, it's definitely a combination of both. I think what's really important for you all, and you can tell me more than I can tell you about this, is being able to act at speed, and therefore having a funding partner alongside you that is able to facilitate acquisitions or facilitate growth in a timely manner is really critical, because you all know that if you're not able to execute things, there's somebody else behind you that's going to come in and take something out of your hands. So I think a partner that is able to act quickly and decisively is really the key. And I think, referring back to some of the questions you asked me earlier, this isn't just about maximum debt you can raise. This is about sensible, well-structured debt for a business that is ultimately sustainable to allow for sustained growth over a longer period of time.
Yeah, so do you see the early years sector as actually being more robust than, say, the care home sector in what's been happening there?
More robust, as robust, not sure is the short answer. Clearly the care home sector has some very similar challenges to the early years sector. Probably some similarities around changing demographics, but certainly similar issues around health and safety, safeguarding, and availability of labour. So, not sure. More robust, less robust, don't know.
No, well, we'll probably find out in coming time. So overall, would you say that you were bullish or bearish about the sector?
Oh, I'm massively bullish about the sector. There's clearly continued growth. There's continued innovation. There's continued differentiation. There's more choice for parents, more choice for consumers. And all of that's great. Competition is a great thing, and I think the sector's held up really well and will continue to be a winner.
Excellent. Well, I'm sure everyone's glad to hear that. So if we can move on then to get some of your participation as well. I wondered initially, does anyone have any questions they'd like to ask Ben before we explore some of these issues?
Sorry, my name's Sam. I'm from Kidsey Nurseries, based in London. My question to you is, what sort of, you say speed is one of the things that you're good at, one of your USPs. What about things like margins? What about loan to value ratios? What about term loans? What sort of durations are you lending for? The banks have come back. I recently had a conversation with our own banks, and they wanted us to almost do away with our current facility and take on a new facility because they weren't making enough money. They were making 1.75 margin off us, and we've now had to renegotiate that with better terms. But the banks are under pressure to actually make money, but where do you sit in terms of your margin, your term loan, how many years, and what kind of loan to value ratio would you typically look to lend?
Thank you. So the beauty of an organisation like OakNorth without 300 years of heritage is that we don't have a portfolio full of legacy transactions that we've done and been involved in, which enables us to be very nimble and look at deals on a true deal-by-deal basis without any specific parameters. So these sorts of things we look at on a deal-by-deal basis. Truly, I mean, I can lend up to 10 years. The reality is, we're always asked about term of loans we do. I can demonstrate to anyone that most bank facilities last for sub 3 years in reality, because there's usually some event within a business that happens, which means something's going to change or need to change. So I would be less concerned about term. Margin clearly is important to operators, but margin is also clearly important to banks. And I think what mainstream banks have been particularly bad at doing historically is pricing debt as a loss leader in order to attract everything else they do. So, for example, they will give you a piece of debt at a cheap rate to enable them to penetrate other services such as credit card terminals, day-to-day banking, online banking, etc., etc. Working with an OakNorth, we are, like I mentioned earlier, we are very pure in what we do. We only do debt. We don't do any of those other services. Now, what that may mean on a headline rate, pound for pound, debt may be, not always, not necessarily, but maybe more expensive, but at least you know where you are and you're not being subconsciously sold other products for a bank to enhance its return. Now, one of the challenges that all the banks have had is they never managed to pick up all those other products that they hoped to at the start of a relationship. So what that has led to is banks having to revisit existing facility agreements in place and repricing, which is exactly what you've seen yourself. So I guess the only plea I would have to everyone here is that banks are here, yes, to lend money on a sensible and responsible basis, but banks are also here to make a return as well.
Okay, is that? Do you want to come back on that?
Yes, I didn't hear any kind of margin from you, so that's very okay. A little bit of a banker's answer. In terms of duration, again, I didn't hear a proper answer from you because you're saying 10 years. I think businesses need to amortise their loans over longer periods because due to inflation, due to all the increased costs, you need to start looking at how you're going to pay the bank back. So it's all very well saying 10 years. I know the facilities might be renewable every 5 years, maybe even, and things do change, you're right. After 3 years, you might buy more sites, etc., so you are looking at that. But overall, it's important to take that into context and say, what are you going to lend over? Because if it's over 10 years, that's quite a short period of time for we've been talking about 10 times multiple, so...
Sure. So no, I didn't mention amortisation, so there's as an institution, we have no issue both with interest-only loans for the right period to enable cash flow to build and operations to stabilise. And for example, if you're buying freehold, then there's no reason why amortisation can't be over a much longer term than 10 years. Slightly different with leasehold premises. And the main driver there will be term of lease, inside the Act, outside the Act, etc.
Any more questions? Well, one over there in the far corner. caller.
Hi there, Andrew Jarvis from Buzzard Bay Nurseries. Just wanted to ask you about sort of credit checks and the process for getting lending in place, particularly around the impacts of COVID. So sort of you mentioned about known and near known cash flows. How much emphasis do you place on prior performance, so where businesses may have struggled during COVID?
Yeah, great question. So I think one of the things that is really important to us is clearly to understand track record over a previously sustained period of time. So for businesses that have been operating prior to COVID, we will go back and we will look at performance. Clearly, COVID was something that nobody had forecasted or wanted. And you know how we would typically look at that period is whilst we will look at it and we'll understand what happened, it wouldn't necessarily be those years that would inform our debt multiples. And equally, that's not always for negative reasons. That could be for positive reasons as well. So, for example, you know, there are certain businesses in this sector and other sectors that have actually fared significantly better in that period. And you could end up leveraging a business too high based on an artificial number. So, you know, the understanding that whole COVID bounce and where does that settle, where does that normalise, is really critical for us. And then your first question was around credit checks. We do a lot of our own proprietary analysis as an institution. I would say that from kind of first meeting an operator, understanding what their plan is, to kind of the cash out the door, the exciting bit, when am I going to get some cash in my bank account to spend then? Again, depending on the flow of information, depending on availability of information, we do deals in 2 to 3 weeks.
Thank you.
Okay, further questions? Well, we could perhaps move on. Sorry, can I take the mic for a moment? Maybe move on to look at slightly wider matters that we touched on in discussion. I thought recruitment is obviously one. We're mentioning the Busy Bees and plans to take on 700 apprentices. Do we have? I think we have someone from Busy Bees here. Do we? I just wonder. Well, they were certainly on the list. Yeah, I just wondered if you'd be prepared to tell us a little bit more about that strategy as part of trying to solve some of the recruitment challenges at the moment.
Hi, indeed. Like everyone else, we've been having real struggles with staffing, and so we've sort of done this recruitment campaign to try and grow your own. I think that's the most important. And it's not solving it right now, but we're trying to look ahead, and that's the main thing. I presume other people are doing the same. We put this recruitment campaign out to try and get the younger generation in and train them up. A bit more of a grey road, isn't it?
Yeah, I agree. It's definitely a long-term plan to try and recruit from within, so they stay with us for a long time as well.
Okay, anyone else doing something similar or other strategies that you're using? Obviously pay is one big impediment, and while there's no more funding, it's hard to raise pay, but are there things that can work to get people into the sector? I'm interested in.
Hi, Teresa from Kids Inc. I joined Kids Inc in May last year, and the first thing we did was look at our apprenticeship providers, and we found just across our 12 settings 19 different people looking after our staff. And for me, it's a worry, because you can't see the consistency, you can't see the quality. So we've now used one provider, and we're working very closely actually writing the programmes with them. Karen next to me. So yeah, I think the way forward is to have control a little bit of your staff training. And one of those things is let's get their passion back into our early years apprentices, because they're the future. So yeah, that's what we've done right from day one, really.
Yeah, so lots of starting from from scratch really. So we've got someone, oh Josh, yeah, got someone in the middle there.
Beverly Walters, Nursery World Show. Just a general question. Based on the economics talk that presentation we had earlier, is anyone finding that the staffing issues are already impinging on budgets in terms of salaries increasing? Are you finding you're having to increase salaries to get the staff in? So for Busy Bees, with those 700 apprentices that you're looking for, have you had to do anything with the salaries to get them?
Yes.
Yes, we raised it up to £6.50 now immediately for existing apprentices and to recruit. Going back to the general question about staffing and recruitment right now, we are finding that there are people that we're trying to recruit are definitely asking for high salaries. We have to be honest, I mean, it is sort of a dog-eat-dog right now where we are trying to compete with each other and trying to offer benefits all the time. And the staff, to be fair, know that they can sort of ask within reason what they can try and get. So we are definitely noticing that the salaries are rising each month, every day, to be fair.
Thank you. Anyone else want to respond on that? Any other strategies that are bearing fruit in terms of recruitment?
I think the problem is early sort of thing, but plus obviously last year, especially from the government last year, so we are trying to work really hard, not just to recruit, but to try and retrain the teams as well. From a parent's point of view, it's a nightmare when the key person leaves and then we're having to recruit someone all the time, so we're working really hard at Busy Bees, trying to train and use our EV training as well. In-house training is really important to try and retain our teams.
Thank you. Jean?
We're going to be talking for a long time, so I won't talk very long right now. But the level 5 and the level 6 is making a big difference from what we can see. So the level 5 is keeping our practitioners in that might have disappeared off into universities or disappeared off into other sectors because they're getting full qualification at level 5 level. And hopefully, if I can convince panel, we'll get a level 6 very shortly for September. So hopefully that will add as well, because I know for myself I've managed to recruit quite a few that are coming to me rather than going to university. So that's hopefully going to help.
Thanks very much for that. Yeah, we'll certainly be coming on to the level 5 in the next session, which is will hopefully help with some of this. So yeah, so just to wrap up then, Ben, for the moment. I mean, what would your advice be to operators going forwards? What are the main points that they should take on?
In terms of raising debt?
Yeah, and growing their businesses.
Yeah, I think one of the things that we see a lot, back to my comment around strength management, is perhaps kind of non-sustainable or non-viable business plans. I think what's really critical, we've just discussed at length pressure on staff cost. If I had £1 for every forecast I saw without staff cost increases included in it, I probably wouldn't be here right now. So I think everybody needs to be realistic and true to themselves around cost pressures in their business and what that looks like on a go-forward basis. Because presenting information to shareholders and to banks that is perhaps predicated on costs that aren't achievable isn't going to do much for anyone. So I think cost control is clearly here to stay in the short term. Site selection remains challenging and there's lots of competition. Good luck to you all.
Well, I'm sure Ben, you'll be very happy to answer people's questions if they'd like to get in touch with you directly as well. So,
thank you very much.
Yeah, so thanks very much to Ben and OakNorth Bank for this session. And yeah, as I say, it will be filmed, so you'll be able to watch back and see that advice again. So thank you, Ben.